The word debt makes most people flinch, but for the wealthy, it's not a ball and chain. It's a rocket engine. It's the difference between sleepless nights and building a dynasty. How can one word mean misery for most, but wealth for a select few? Because the rich don't just handle debt differently, they think about it differently. For them, debt is a powerful servant, and this video will show you exactly how to command it. If you find this information valuable, tapping the like button helps spread this knowledge to others who need it. In the next few minutes, you will learn 14 specific, actionable strategies. This isn't theory, it's a playbook. 7 are safety plays designed to eliminate the debt that bleeds you dry. The other 7 are wealth plays, the exact strategies used to turn calculated debt into a money printing machine. You don't need an MBA or a trust fund to do this. Master just 3 of these plays and your financial life will change. Grab a notepad. It's time to begin. Section 1. Safety plays. Kill bad debt before it kills you. The first step in the playbook is simple. The rich sort debt into 2 piles, good debt that pays you and bad debt that costs you. Before wealth can be built, that second pile has to be torched. Bad debt is a cancer on your financial health, and it must be treated with scorched earth tactics. Strategy 1. The debt freeze. Stop adding consumer debt. Full stop. Delete stored credit cards from Amazon, your phone, and your browser. Start living on last month's income, which forces you to be a month ahead and breaks the paycheck-to-paycheck cycle. The rule is simple. No more high-interest, non-essential purchases on credit. You're rewiring your brain for security over consumption. Strategy 2. The avalanche. This is the mathematician's approach. List every balance you owe with its interest rate. Sort that list from highest rate to lowest. Now, attack the loan at the top with every spare dollar, while paying only the minimum on everything else. Once that top debt is gone, roll the entire payment onto the next highest rate. The math is undefeated. This method saves you the most money on interest. Strategy 3. The snowball. What if your motivation tanks? If the avalanche feels like punching a mountain, use the snowball. List your debts by balance, smallest to largest. Attack the smallest debt first. You might pay more in interest, but the psychological win of clearing a balance is a powerful motivator. Then, roll that payment onto the next smallest target, creating a snowball effect. The best method is the one you actually stick with. Strategy 4. The consolidation squeeze. If you're juggling multiple high-interest cards, consolidation is a powerful move. You take out one new, larger loan at a lower rate, like a personal loan at 9%, to pay off all your 20% cards at once. You get one payment and lower interest costs. 2 critical rules. 1. No origination fee above 3%. 2. The day the cards are paid off, you physically destroy them. Don't close the accounts, just cut up the cards to avoid the temptation of running them up again. Strategy 5. The ratio radar. Your debt-to-income ratio, or DTI, is your total monthly debt payments divided by your gross monthly income. Lenders obsess over this, and so should you. They prefer a DTI under 36% for new loans. Calculate this number quarterly. If it's creeping up, it means your debt is outpacing your income. You have 2 choices: cut debt or raise income. Keeping a low DTI is crucial for the wealth plays we'll discuss later. Strategy 6. The automation shield. This is the simplest play. Set all your bills to auto-pay at least the minimum payment. A single $35 late fee represents a massive negative return on your money. Automating payments protects your credit score, eliminates needless losses, and frees up your mental energy for bigger things. Strategy 7. The lump sum ambush. When you get a windfall like a bonus or tax refund, resist the urge to splurge. The rule is 90% goes straight to the principal of your highest interest bad debt. The other 10% is your guilt-free fun money. Firing a lump sum at the principal nukes future interest payments and can shave years off your loan. Section 2. Wealth plays. Turn good debt into a money printer. The fires are out. Time for offense. Now we use the same tool. Debt with a new job. Leverage. This is how the wealthy separate themselves. Strategy 8. The real estate slingshot. This is a classic. Put 20% down on a $300,000 duplex, financing the rest. You live in one unit and rent out the other. If your total monthly cost is $1,750, but your tenant pays you $1,400. Your cost to live is now just $350. Later, you move out and rent both sides for $2,800. After expenses, you net $1,050 a month in cash flow. Your tenants are paying off your loan while the property appreciates. That's using leverage to have someone else buy you an asset. Strategy 9. HELOC recycling. Once you have home equity, you can open a home equity line of credit, or HELOC. It's a credit line secured by your house with a much lower interest rate than other debt. A wealthy person might pull $50,000 from a HELOC to buy a portfolio of index funds yielding 9% a year. The dividends from the funds help pay the interest on the HELOC, while inflation erodes the real value of the loan over time. It's using one asset to acquire more assets. Strategy 10. The securities-backed line of credit. This is a billionaire move. If you have a large stock portfolio, you can get a securities-backed line of credit, SBLOC, against it. The rates are incredibly low, often 1 to 2%. Instead of selling stocks and triggering capital gains taxes, you just borrow against the portfolio. Your money stays invested, capturing market upside, while you use the cash for your next venture. The risk is a margin call if your portfolio drops, but it's a key tool for the ultra-wealthy to access cash tax-free. Strategy 11. The leveraged buyout, small scale. You don't need to be a private equity firm for this. Find a profitable laundromat for sale for $400,000. Offer the retiring owner $100,000 in cash and ask for a seller note for the remaining $300,000. This means the seller acts as the bank. You then use the business's own cash flow to make the payments. In a few years, the note is paid off, and you own a cash-flowing asset that essentially paid for itself. Strategy 12. Geared managed funds. This is how regular investors can access leverage. Some ETFs are geared, meaning the fund itself borrows money to invest more into the market. A $10,000 investment might get you $15,000 of market exposure. This amplifies returns, but also losses. In a tax-free account like a Roth IRA, this amplified growth can be incredibly powerful over the long term. Strategy 13. Private debt funds. This is for accredited investors. Instead of borrowing, you become the lender. You invest in a fund that lends your money to dozens of mid-sized companies, earning you a steady yield of 8 to 12%. The risk is spread across many borrowers, so one default doesn't wipe you out. Compare an 8% yield to the 0.5% from a savings account, and you can see the appeal. Strategy 14. Buy, borrow, die. This is the ultimate wealth transfer strategy. 1. You buy appreciating assets like stocks and real estate. 2. You never sell them. When you need cash, you just borrow against those assets using a tool like an SBLOC. 3. At death, the step-up in basis rule kicks in. Your assets are revalued to their price on your date of death. Your heirs can then sell them immediately and pay zero capital gains tax. The massive tax bill you would have incurred is legally erased. If this is clicking for you, press the like button so the algorithm shows this to someone who might be stuck in 24% credit card hell. And subscribe. The next video breaks down how hedge fund managers legally pay lower tax rates than their interns. Mindset Shift Checklist. This isn't just about tactics. It's about rewiring how you see money. Burn these 5 principles into your brain. 1. Good debt pays you, bad debt costs you. 2. Borrow against assets that produce cash flow, not against your future labor. 3. A long-term fixed-rate loan is a gift in an inflationary world. You're repaying it with cheaper dollars over time. 4. True diversification isn't 10 tech stocks. It's 10 different borrowers in different industries. 5. Never finance depreciating items. If it doesn't appreciate or produce income, pay cash or pass. A car note is a wealth anchor. Quick fire. Examples you can steal today. Example A, the 25-year-old analyst. She gets a $15,000 bonus but has a $12,000 credit card balance at 22% APR. Instead of investing the bonus, she uses the lump sum ambush and wipes the card clean. That single move saves her over $3,200 in interest in 1 year. A guaranteed 22% risk-free return. No stock can guarantee that. Example B, the teacher couple. They have $40,000 in student loans at 6.8%. They do a cash-out refinance on their mortgage at 3.5%, pulling out $40,000 to vaporize the student loans. This cuts their interest rate almost in half and frees up hundreds in monthly cash flow. Example C, the freelance designer. His credit is weak. He opens a secured credit card with a $500 deposit. He uses it only for his monthly software subscription and sets it to auto-pay the full balance. A year later, his score has jumped 110 points, qualifying him for better loans. Risk gauges the rich never skip. Using debt for wealth isn't gambling. It's calculated science. The rich never make a leveraged move without stress testing it first. Before buying a rental or taking a portfolio loan, they run the numbers on a hurricane scenario. What if vacancy hits 20%? What if interest rates jump 3%? What if the market crashes 30%? If the deal still survives that nightmare, only then do they proceed. Amateurs focus on the upside. Professionals obsess over the downside. The 30-day action plan. Talk is cheap. Here's a plan for the next 4 weeks. Week 1. List every single debt. Creditor, balance, interest rate, and minimum payment. You cannot fight an enemy you don't understand. Week 2. Pick your weapon, avalanche or snowball, and automate the extra payments. Automate your discipline. Week 3. Check your credit score and full report for free. Dispute every single error. A few points can save you thousands on future loans. Week 4. Read The Value of Debt in Building Wealth by Thomas Anderson. It will solidify the mindset discussed here today. Debt isn't a moral issue. It's like carbon. The same element can form worthless graphite or a priceless diamond, all depending on how it's structured. If you let banks structure your debt for their benefit, it will eat your future. But if you seize control and structure it deliberately, it becomes the most powerful engine for building wealth. This isn't an overnight fix. It's a change in your financial operating system. Start with one move. Pick one safety strategy and one wealth strategy. Implement them this week and start the engine. You'll be activating the same principles that billionaires use to build their fortunes. Comment below with the one strategy you're going to tackle first, whether it's a safety play or a wealth play. Let the community know what you're working on to encourage and support each other. Like, subscribe, and share this with that friend who still thinks a car note is a normal part of life. It's time to break the cycle.